Welcome to Finance Made Easy. Risk is an unavoidable part of human society. Death, illness, unemployment, car accidents. These can all have a huge impact on our lives. The same goes for businesses. Agriculture is dependent on the weather. Industrial investments are high, and the risk of failure is significant. Businesses face many uncertainties. In ancient societies, human tolerance for risk was quite low. How did people manage it? They relied on families and clans to share the risks. For example, in ancient China, scholars traveling to the capital for the imperial exams would often depend on wealthy families within their clan for financial support. Similarly, families with widows and orphans often had to rely on the clan's elders for help. These risk-sharing mechanisms were based on bloodlines or regions. They were fragile and difficult to quantify, so they couldn't be scaled up. As a result, human economic activities were severely limited. But modern financial markets and tools have changed all that. Here's an interesting example: agricultural insurance in the United States. In the summer of 2012, the U.S. experienced its worst drought since 1956, and corn was the hardest hit crop. Some areas in the Midwest even saw total crop failure. In ancient China, this would have meant mass poverty and potential social unrest. But fortunately, the U.S. has a very developed agricultural insurance system. Here's how it works. Every farmer across the country pays a certain insurance premium. If a covered farmer suffers losses, these funds are used to compensate them. Thanks to agricultural insurance, during the 2012 drought, corn farmers actually saw their income rise rather than fall. Why? Because with the drought, corn production dropped, which led to a 60% increase in the market price of corn. Insurance payouts are calculated based on historical yields and current market prices. So, a farmer who typically made $1,000 per hectare of corn before the drought found that, thanks to the price increase, their payout was actually $1,280 per hectare. This insurance mechanism allowed farmers to effectively hedge against the risk of natural disasters and provided them with a great sense of financial security. Insurance, with its risk-sharing function, has given humanity tremendous freedom. We're less reliant on nature, and individual risks are spread across society. This is the role of insurance. Let me give you another example of how financial risk-sharing can bring other changes to human society. As we all know, in the 17th century, the Netherlands was the world's most powerful maritime empire. The rise of this empire was closely tied to a financial tool with a risk-sharing function. In the 16th and 17th centuries, the Netherlands had a company called the Dutch East India Company, which sought to expand overseas trade. However, long-distance trade faced two major constraints. First, the high cost of shipbuilding. Second, the enormous uncertainty of maritime trade, which made it difficult for just the captain or crew to manage such ventures. To address this, the clever Dutch devised a mechanism. They allowed Dutch citizens to buy shares in the East India Company. By purchasing shares, they could share in the profits of the company's overseas trade. This was profit sharing. But if the voyage failed, the money invested would be lost, which was risk sharing. Through this profit sharing, risk sharing mechanism, the financial risks of overseas trade were spread across the shareholders. As a result, the company raised substantial funds, and the crew could embark on their voyages without financial worries, paving the way for the Dutch to build their maritime empire. Some might ask, these events happened over 400 years ago. Does risk-sharing in modern finance still help us today? Absolutely. Take venture capital as an example. It has played a huge role in encouraging business innovation and entrepreneurship. Starting a business is not a game, it's a life or death challenge. Don't just think about ordinary people. Even billionaires can go bankrupt if they're not careful. Take Elon Musk, the famous tech entrepreneur and founder of Tesla. From a young age, he dreamed of exploring space. By 2002, He had already made a fortune and founded a private space company, SpaceX, with the ambitious goal of enabling human interplanetary migration. At first, Musk thought that, as a billionaire, he could go it alone. But he soon learned that launching rockets isn't cheap. Each launch cost hundreds of millions of dollars. Between 2006 and 2008, SpaceX suffered multiple failed launches, and even Musk, a billionaire, almost went bankrupt. After this, Musk had a realization and decided to seek outside funding. Over 100 venture capital firms, including top global funds and tech giants like Fidelity and Google, invested in SpaceX. In just the early 2015 Series E round, they raised a total of $1 billion. With venture capital backing and risk sharing, Musk felt more confident and moved faster, accelerating the progress of his projects. By 2010, SpaceX's Falcon 9 rocket successfully launched a Dragon spacecraft into orbit, making history. No private company had ever successfully launched a rocket before, but SpaceX did. After this success, SpaceX won many government contracts and even began transporting cargo and astronauts to the International Space Station. So, just like the Dutch East India Company's maritime adventures, Musk's journey to space was also a product of financial risk sharing. Without venture capital, SpaceX might have failed before its dream could come true. As you can see, both stocks and venture capital have allowed us to push the boundaries of risk tolerance, overcoming geographic and temporal limitations. Individuals and businesses are now empowered to take on much greater risks, and as a result, the scope of human economic activity has expanded dramatically. This is Finance Made Easy, helping you gain a higher perspective and re-understand wealth.